Hi everyone, my name is Mark Quinn. I'm a tax advisor and chartered financial planner based in Portugal, and I help expats relocate to Portugal. In this video, I'm going to look at the Non Habitual Residence 2.0 scheme, which is the successor to the old NHR regime. So just to give some background, there was a scheme called the Non Habitual Residence scheme. That was a 10-year tax incentive scheme to attract new residents to Portugal. And it was introduced in 2008 by the Portuguese government, very successful in attracting a new group of visitors to the country that wouldn't really have known much about Portugal prior to that, and that had a 10-year window to live very tax effectively at little or zero tax. Now, unfortunately, that old scheme was cancelled with effect from 2023. So I think it was the 6th of October 2023, the government announced that the NHR scheme would be closing. There was a grace period, so there were some transitional rules introduced at the time, meaning that people could still apply as late as the 31st of March this year and still get into the NHR scheme, the old NHR scheme rather. Now, obviously, that deadline has passed, but with the cancellation of the old NHR regime in 2023, they actually introduced another tax incentive scheme, and that's basically called the Incentive for Scientific Research and Innovation. So it's shortened to IFICI. But because it's a bit of a mouthful, a lot of people in the sort of tax planning community here are calling it NHR 2.0. It's basically a second evolution of the previous tax scheme. And although the scheme has existed in legislation since the 1st of January 2024, on a practical level, it wasn't actually possible for people to apply for membership of the scheme because the forms, the documentation and the processes didn't actually exist in practice to be able to get into the scheme. Now that changed with effect from February, so still very early days, but the new NHR scheme, NHR 2.0, is now open for business and ready for new applicants to get into the scheme. So what are the tax benefits in applying for the new scheme? Well, in many ways, they're actually more wider ranging than the old scheme. And I'll compare and contrast the two just to give you an idea of how the new regime differs to the old. So under the first version of the non-habitual residence scheme, pensions income was treated favourably. You were taxed at either 0% or 10%, depending on the date you entered into the NHR programme. Capital gains on overseas property were also free of tax, and dividends and interest from overseas jurisdictions were also potentially tax-free. One thing that NHR didn't cover, which was quite relevant to many of our clients, was capital gains on shares and securities, particularly those of you that were selling businesses. The NHR programme, as it existed then, didn't help in any way. It was generally geared towards income, and so you'd pay full capital gains tax if you were selling assets as a Portuguese tax resident. Now, the new NHR programme, NHR 2.0, gives the potential for completely tax-free overseas income and gains. So in many ways, it's wider ranging than the old programme. The only exceptions to the new regime is income from pensions and income from blacklisted jurisdictions. And the most common blacklisted jurisdictions for our clients are Guernsey, Jersey, Isle of Man, Cayman Islands, etc., etc. However, even on the pensions aspect, even though pensions aren't necessarily incentivised under the new NHR regime, there has been a quirk which puts a question mark over how they will be treated, and some tax experts here are actually suggesting that potentially pensions may also be exempt from tax, and I'll cover that point a bit later on in the video. The final aspect of the tax benefits of the new programme, and this is the same as the old programme in a sense, in that it incentivises certain categories of workers. So if you're performing what's called a high valued activity, then you qualify for a 20% flat rate of income tax, which is particularly attractive when you consider that the standard income tax rate can go as high as 48% in Portugal. So how do you qualify for the scheme? Well, again, contrasting it with the old scheme is probably useful. So under the old scheme, anybody could apply for non-habitual residence. The main criterion was that you hadn't been a tax resident in the last 5 years in Portugal. Besides that, there was no real other criteria that you'd have to satisfy besides having a residence here, be it a rental or a home that you own already. So we had a lot of retirees, for example, that could come here and use the NHR programme. Now, under the new NHR scheme, it's going to be a lot more restrictive in the sense that it's geared towards people working in certain occupation classifications. And the name, the incentive for scientific research and innovation gives the clue as to which type of workers it's targeting. So it's aiming at those particular classes of occupation. But as a result of a recent amendment to the law, that has actually extended the types of worker that can qualify under the scheme. So it's not necessarily it's not necessarily people just involved in scientific research and innovation or teaching in higher academic institutions. The occupational list now has become a lot more wide. One particular class of people that may benefit and is applicable to a lot of our clients or potential new clients is people that are still running businesses. Now, there is one class or segment that you may be able to qualify under, which means that if you have a Portuguese business which exports more than 50% of its turnover outside of Portugal, so for example you're running a consultancy business here in Portugal where your clients are actually based outside of Portugal and more than 50% of its revenue derives from outside of the country, then you may be able to get into the scheme. So it could be a very attractive position to be in. You know, if you're running a business, you may ultimately want to sell those shares in the future. As I said, under the old NHR regime, that would have been subject to 28% standard capital gains tax rate. Now, if it's deriving from an overseas transaction, again, potentially capital gains tax free, and any dividends and interest taken from the investments, again, could be free of tax. So potentially a fantastic opportunity for you. In the same way as the old scheme, the qualifying condition as well for membership of the new scheme is that you haven't been a tax resident here in the last 5 years, so same point as previously, but also you can't have benefited from the old NHR regime. So 2 additional points there. Can't have been tax resident in the last 5 years and also benefited from NHR in the past. When we're looking at making the move to Portugal as well, we also have to think about the jurisdiction we're leaving, because it's all well and good meeting the conditions on this side of the pond, so to speak, but you also have to make sure that you're detaching yourself from your current system. Now, if you're in the UK, there's 2 particular aspects to consider. One is you need to cap your time in the UK going forward, and 2 is that you need to think about the 5-year anti-avoidance rule from a UK context, and I'll cover each of those points in turn. So the first point, limiting time in the UK. If you want to come here in Portugal and take advantage of the new NHR 2.0 programme, you now have to limit your time in the UK. Because when you leave the UK tax authorities doesn't want you coming back as and when you choose. They're going to impose strict time limitations, or what we call day counts, on how much time you're allowed to be back in the UK. Now that can be as little as 16 days and as much as 182 days. Some people believe it's 90 days, but it can be 90 days, but it really depends on each person's situation and circumstances and their family position. And it really depends on how many ties and connecting factors you have to the UK. This is all governed by what's called the UK Statutory Residence Test 2013. So there's no grey area here. It's very clear in the sense that it gives you certainty. You work through the test in order, and it will give you a day count that's applicable to you and your family situation. However, working through that test is complicated, so I would encourage you to get advice to determine that you're not falling over any traps in that respect. In relation to that point as well, it's important that you keep a tracker of how many days your spending in and out of each country. So keep a simple spreadsheet, a few columns, UK, Portugal, elsewhere, and just tally your days up each year. And also just be cognizant of the fact that, you know, the UK works from an April to April tax year, so 6th of April to the following 5th of April. The Portuguese tax system works on a calendar year basis, but to make matters even more complicated, the definition of tax residency in Portugal is actually based on a rolling 12-month period. So there's lots of moving parts there, so just make sure you're keeping accurate records in case you ever are challenged on where you're spending your time. And the other point to consider is the 5-year anti-avoidance rule. So the UK imposes certain restrictions on former UK residents. So if you leave the UK and dispose of shares in businesses, for example, or take large payments from a pension scheme, and then you return to the UK within a 5-year period, you will be subject to tax on your return. You need to be clear of the UK tax net for at least 5 complete tax years after you've left. So you need to take that into account in your planning when you're assessing the validity of the move. I mentioned earlier in the video there's a sort of weird quirk of how pensions may be treated under the NHR 2.0 programme, and that's as a result of 2 factors really. The first is a mismatch in what we think of as pension schemes rather than the Portuguese authorities. So from a Portuguese standpoint, a pension is a regular series of payments. It's not, for example, a large lump sum drawdown as we're familiar with from a UK context. And there's a recent ruling in Portugal whereby a client had taken out a large lump sum from his pension scheme, and the authorities actually contested that it wasn't actually a pension withdrawal, even though we know from a UK context it was coming from a pension scheme. They said, well, in our eyes, this doesn't meet the criteria of a pension scheme, and therefore we're going to tax it as investment income. Now, for this particular client, under the first version of the NHR scheme, it meant that he had more tax to pay than he thought. However, this leaves a question open for people coming in under the new NHR programme, because as I mentioned at the start, pension income isn't treated favourably under the new regime. However, investment income is. Now, if the court ruling is saying, well, a large lump sum withdrawal from a pension scheme isn't actually a pension and it's now going to be treated as investment income, what rate do we apply? That would seem to suggest that if pensions are treated as investment income and overseas investment income is tax-free, then under the new NHR regime, pensions could potentially be tax-free. However, this is a very new ruling, and it's a very grey area. So, as I always say in my videos, please take advice on your individual situation, circumstances, and objectives. Because tax is law and law is open to interpretation. It's important that you get this right at outset when you're doing your planning. And the final point I just wanted to make in the video is just the practicality in terms of the deadlines of applying for the scheme, which is you have to apply for IFICI by the 15th of January following the year that you get residency. So if you get your residency sometime in 2025, you're going to have until the 15th of January 2026 to apply for NHR 2.0. So I hope you found that video useful. As I always say, this isn't advice, it's just education and guidance. Please do seek individual advice on your specific situation and what you're looking to achieve in your relocation to Portugal. Thank you.